Ladies and gentlemen, welcome to the Startup CFO and the elements of financial controlling. Every startup CFO knows that cash flow is very important, and this is what he's gonna watch actually on a daily basis. Short term, long term, and a good startup CFO knows what to do. However, there's more to the task of the startup CFO, and only because we talked about the cash flow statement extensively, I don't want to say that he doesn't have to think about the balance sheet and the income statement or profit and loss statement. This is why briefly commenting on the general controlling role. So first of all, and this is empirical evidence, 80% of startups fail because they do not have good controlling mechanisms. And this is still a very narrow definition of controlling, but if you go into the startups, it's a good understanding for the CFO, and you can always see that. First of all, a CFO has to gather the relevant information. Before you start, you try to understand the industry and all sorts of things. You build your cash flow statement and so on. Building your cash flow statement also means you plan, you try to understand what the cash flows are, what the necessary financing is, and sorts of things. And this is what you use to steer actually the business, help your CEO to run the business, or help your co-founders to run the business. And if you have done that, try to understand whether you did it right or not, just easily to put it. And you can go into more detail on this slide to understand the four core functions and the information role, which is a good understanding of the startup in general and the strategy and all sorts of things, but also going into deeper into the reporting system necessary for your understanding, for your learning, and then going into your active role of planning and coaching first, and then steering the CEO. And then at the very end, doing the supervisory role, which is also understanding whether you did something wrong, because you're still in an early stage, you're still facing the uncertainties. You might have wrong information. Industry structure is different for you than for others, and all sorts of things. And this is what kicks back into your information gathering and ideally into the cycle again. So this is in general what a startup CFO does as controlling, be it the cash flow or be it, and I don't want to say no, startup CFO doesn't have to do it, balance sheet and income statement. You need to do a balance sheet income statement because this is the basis where you pay taxes on. So the tax authorities will ask for your income statement, and they will want to see the balance sheet once a year. So the balance, and this is why I'd like to briefly go into that. So start with the balance sheet, which actually gives you an overview of the firm's assets versus liabilities, which are the actually two sides of the balance sheet, assets on the one side and liabilities on the other side. Or so to say that, where's the money coming from and where's the money going? And ideally, the money is going into things which you can use to make more money. And ideally, you make more money than you have to pay for your investors. And if you do that, you'll be positive, you'll make money, and this means you have a successful company. Sounds very easy. In practice, it's not easy because it's depending on your business, which are the assets you have to invest in, the non-current assets, which are the investments, which also are the current assets, and on the other side, where the money is from, equity and liabilities, and where it goes into the current liabilities. There's short-term financial debt and the accounts payable. So the balance sheet gives you once a year a general idea on assets versus liabilities. And actually the big difference between a startup and a corporate is that on the basis of the current assets. So if you look at here, B and C down here, current assets versus current liabilities, a corporate normally makes money on that basis. So normally the current assets exceed the current liabilities, and this is how the pockets of the shareholders are actually filled normally. In a startup, it's different. It's vice versa. Actually, limited or no profits or free cash flow, which means the shareholder equity is going negative, which means that you have to obtain financing. And this is the difference. You have to have outside financing in order to build your business. Big corporates don't necessarily need it. I mean, if you look at Apple or Microsoft, they have billions on the bank account, and even other established corporates do have that, and they can finance all their activities by using their own bank accounts. If you want to grow more, you might also want to have outside financing, but that's not necessary. Startup, it's different. It is necessary. That's the balance sheet. The second thing is the income statement or profit and loss statement, where you list actually the profits and losses or the incomes and your cost structure, so to say, which is looking at your sales, giving you the gross profits, and then deducting actually all the costs, ending in the operating income, and then you can calculate all the other numbers in order actually to be prepared to pay the right taxes. And this is what you also have to report on a yearly basis to your tax authorities, because if you have positive pre-tax income, they want to see you paying taxes for that. And in most cases, you won't have it as a startup, but that's a different question. This is why you have to finance. The difference between cash flow and income statement, again, if you look at the income statement, you find the depreciation and amortization in here. So this is costs in your income statement. Means if you buy a machine for $1 million, you can and you use that for 10 years, you normally can put 1/10 of the million into your income statement. However, in the cash flow statement, $1 million goes out of your cash. That's the biggest difference between the two sides, the depreciation and the amortization. Also the biggest challenge, because in the income statement, you might have a profitable business, and then tax authorities come up and want taxes from you. On the cash flow statement, you might be totally negative because you can't pay the bills, you had to pay for the machinery. And this is why you first of all have to monitor the cash flow, because this is the most honest thing. The cash goes out, the cash comes in. And in that case, depreciation, amortization is unclear because there are general rules, but the rules might be different. But you have to do that once in a year as a startup CFO, providing the income statement, building the balance sheet, and that also gives you at least some information, which is important. At least it's important for the tax authorities.